Alright, so the quality on this video is going to be bad because I don't really want to put on my headset because I don't want to mess up my hair. But let me show you guys how to use standard deviation. Okay, now this is a tool that predicts most highs and lows perfectly and is really just a place, really just a tool to use take profits and where to try and enter a trade. So whenever the market is trending, okay, the swing low, okay, the swing low to the previous swing high on the 5 or 15-minute time frame. That's pretty important. Okay. And then price gets up to the negative 2.25 or 2.5. Okay. What it will do is it will normally reject off one of these, like almost to the tick. Okay. So you're given quite a bit of levels, but if you compare them with other things, they're obviously high probability. So once you see price get up there, you can expect it to, dump with some other things as well. So this can be used to, tell you where to enter. It can also be used to tell you where to target. So I'm going to do the same thing here. Okay, you draw your standard deviation on the 5 or 15-minute time frame from the high to the swing low on the left. What the heck? Okay. And now, if you were able to short, off of something here, what you can do is you can say, okay, which one of these levels lines up with liquidity? So, just for demonstration purposes, okay, we'll do that. There. So as you can see, the swing low at negative 4.5 is underneath the liquidity. So if we expected the liquidity to get taken, it'd get taken down to negative 4.5. Or if you want to be safe, you can just target negative 2.25 or 2.5 or 2. Okay. So that's how you're going to use the standard deviation. It's really simple. If you want to see some more examples of it, I can. But I also want to show you guys one more concept, okay? So whenever you see price respect a crossed candles just like this, or a charted volume imbalance, okay, so it respects it. At the low point, it will almost always leave liquidity. So if we're gonna, if price respected it to the upside, we're gonna mark the lowest part, like that to the left, and it's gonna work as liquidity just like that. Now if we look here, it does the same thing. Boom, charted volume imbalance, respected the highest point, liquidity. Okay, that's just some things that I noticed. I only really saw it on those two examples, but yeah, that's pretty cool to know some more uses of it. I've been kind of looking more into like some different concepts as well, trying to trade those. But boys, I will say the X model does not work at all. So don't even try and use the X model. It does not work. So I almost failed a 15K funded evaluation on Forex just because I was trading the X model. Had nothing to do with my skill. So I'm going to try and revive that. But yeah, I thought I'd just show you guys how to use standard deviation and then just some little notes on charted volume imbalance and crossed candles.